Hello learners, in Unit 1 we have learned that accounting process consists of a number of processes such as identifying, recording, classifying, summarizing and interpreting the financial transactions of a business. Today we will discuss about journal. Journal is nothing but a diary of business transactions. In this topic we will be covering the meaning of journal, PERFORMA of journal, and advantages of journal. Well, before starting with the meaning, we will try to understand the concept with the help of an example. Mr. Jack started a new business on 1st February 2017 and invested $2,000 as capital. He purchased a table worth $105 on 14th of February. He made another transaction worth $15 on 21st Feb. On 22nd of February, he sold goods worth $50. On 28th Feb, Jack made payments for rent, salary, printing and stationery worth $300, $250 and $57 respectively. To memorize these transactions, Jack will record these transactions in a specific book. This book is called journal. Let's start with the meaning of journal. It records daily transaction of the business in order of their occurrence. It shows the name of accounts and amount to be debited and credited. The process of recording transaction in journal is called journalizing. Journal is one of the books of original entry. Journal has a specific proforma to fill. The form of journal known as general journal is given as date. It is the column on which date when transaction was made is recorded. Particulars. The two aspects of transactions are recorded here, that is, the details regarding aspects to be debited and credited. Ledger folio. The transactions entered in the journal are later posted in the ledger. The relevant ledger folio is entered here. Debit. Amount to be debited is entered here. Credit. Amount to be credited is entered here. Before discussing how to pass journal entries, let's discuss different types of accounts and their rules of debit and credit. The first type of account is called real account. All assets of a firm which are tangible or intangible fall under the category real accounts. Tangible real accounts are related to things that can be touched and felt physically. A few examples of tangible real accounts are building, machinery, stock, land, etc. Intangible real accounts are related to things that cannot be touched and felt physically. A few examples of such real accounts are goodwill, patents, trademarks, etc. Rule for real account is debit what comes in, credit what goes out. Real accounts involve machinery, land and building etc. They have a debit balance by default. Thus, when you debit what comes in, you are adding to the existing account balance. This is exactly what needs to be done. Similarly, when you credit what goes out, you are reducing the account balance when a tangible asset goes out of the organization. Second type of accounts is personal account. These accounts are related to individuals, firms, companies, etc. A few examples of personal accounts include debtors, creditors, banks, outstanding, prepaid accounts, accounts of credit customers, accounts of goods suppliers, capital, drawings, etc. Personal accounts are further classified into three subcategories. First one is natural personal accounts. This type of personal account is the simplest to understand out of all and includes all God's creation who have the ability to deal, who in most of the cases are people. Example is Andy's account, Adam's account, etc. Second one is artificial personal accounts. Personal accounts which are created artificially by law, such as corporate bodies and institutions, are called artificial personal accounts. Examples are private limited companies, clubs, schools, etc. And the last type of personal account is representative personal accounts. Accounts which represent a certain person or a group directly or indirectly. For example, let's say that wages are paid in advance to an employee. A wage prepaid account will be opened in the books of accounts. This wages prepaid account is a representative personal account indirectly linked to the person. Now, the rule for personal account is debit the receiver, credit the giver. When a person gives something to the organization, it becomes an inflow and therefore the person must be credited in the books of accounts. The converse of this is also true, which is why the receiver needs to be debited. And the last type of accounts is nominal accounts. Accounts which are related to expenses, losses, incomes, or gains are called nominal accounts. The dictionary meaning of the word nominal is existing in name only, and the meaning remains absolutely true in accounting sense too, because nominal account do not really exist in physical form. But behind every nominal account, money is involved. Examples are purchases account, salary account, sales account, commission received account, etc. Final result of all nominal accounts is either profit or loss, which is then transferred to the capital account. Rule for nominal account is debit all expenses and losses, credit all incomes and gains. The capital of a company is a liability, therefore it has a default credit balance. When you credit all incomes and gains, you increase the capital, and by debiting expenses and losses, you decrease the capital. Now, we will move to the practical questions of journal. First point is goods sold to John for $75,000 and payment received through check. In this point, goods are sold to John for $75,000 and payment is received through check. That is why we will mention bank account. So in this question, the entry will be bank account debit to sales account, that is $75,000. The reason behind debiting bank account is because bank account is a real account and debit what comes as the rule for real account. In second entry, $40,000 received as commission in cash. So the journal entry will be cash account debit to commission account. In third entry, $30,000 paid as insurance premium by checks. So the journal entry will be insurance account debit to bank account. The bank is being credited because debit what comes in and credit what goes out. So bank being the real account is going out of the business, that is why we are crediting bank account. Next entry is amount deposited into bank $5 lakh. So in this case, journal entry will be bank account debit to cash account. Bank is coming into the business and cash is going out of the business. And the last journal entry is $85,000 withdrawn from bank for personal use, known as drawings. So the journal entry will be drawings account debit to bank account, as bank is going out of the business. Now, it is time to discuss the advantages of journal. It starts with chronological order in which the transactions are recorded on the basis of date, so there is no chance of omission. Next advantage is journal is a reliable evidence because all the transactions are recorded firstly in book. That is why it is also known as book of original entry. The third one is early detection of errors, which means errors like posting of wrong amount, posting in the wrong account, posting on the wrong side of account, etc. can be detected. And the last advantage is we have improving efficiency of persons as all the transaction is recorded in chronological order. As a result, it saves the time of accountant and improve the efficiency.